Hey everyone, Dan Longman here with Priority Lending. I'm coming to you today with our mortgage market update. Big topic in our industry, as always, is interest rates, so I want to start there. So those of you may have already heard, the Federal Reserve met this week on Wednesday, and as expected, they increased the federal funds rate by 0.5%. I get this question all the time. Does that mean interest rates went up by 0.5%? The answer is no. Now, interest rates have gone up. We've seen interest rates increase steadily here over the last few weeks, over the last couple months, and it's been quite a big jump compared to where we were last year or even at the end of last year. But the federal funds rate and the mortgage rates sometimes can run parallel, but sometimes they don't. It just so happens mortgage rates are going up at the same time the Fed is increasing it. But the big culprit behind mortgage rates going up is inflation. And the Fed, when they make announcements and they're saying that we're going to hike rates, like they have said, the short-term rate, when they say they're going to hike it 3, 4, 5, 6 times, the mortgage market reacts to that immediately. So our rate, that's why we've seen rates go up and they continue. I mean, the Fed has only made 2 increases so far out of these 5 or 6 or 7 that they had promised, but mortgage rates already reacted on that just from the actual news of it. But you will continue to see mortgage rates go up until this inflation is under control. I had mentioned before, the Fed's job is they kind of operate like the gas pedal and brake in your car. When the economy is there's a lot of demand like we have now and prices have increased, the Fed tries to act as the brake in your car to slow it down. How do they slow it down? By increasing rates. When things become more expensive, the theory is that people will spend less, right? And the reverse is true. When things are slow and they want to spark the economy, they will lower rates to increase spending. But obviously the situation we're in today is, we have massive inflation. A lot of this, stems back from COVID and the issues of the supply chain, which still is an issue right now. Many other factors as well. But anyway, so interest rates, have gone up. But I do want to talk real quickly, going back to the federal funds rate, which I mentioned before, but I just want to reiterate is, what does that impact? Like, what can you see happen as a result of that right now? And this is your short-term financing. So the biggest thing that we see being in the mortgage industry is equity lines of credit. So a lot of you folks out there, your equity line of credit is tied to the prime rate. And the prime rate was sitting prior to Wednesday at 3.5%. The federal funds rate the prime rate moves in direct correlation with the federal funds rate. So when that goes up a quarter, the prime rate's going to go up. So federal funds rate just went up 0.5. The new prime rate now is going to be 4%. It was at 3.5, now it's at 4. So a lot of you that have equity lines, you're usually at a rate of prime plus something, prime plus 1, prime plus 2, prime plus a quarter, whatever it may be. But just know you're starting now at 4. So if you're prime plus 1, you're 4 plus 1, you're at 5 now. If you're prime plus 2, you're at 6 now, et cetera. So just keep that in mind. You're going to see those probably on your next month's statement that go into effect. But it's important to know because when the Fed is making these announcements of we may raise it 3, 4, 5, 6 times this year, that will impact your equity line. You're also going to see it on short-term loans like credit cards, car loans, et cetera. So just be cognizant of that. But just shifting over to mortgage rates. Yes, mortgage rates are absolutely in the 5% range. We're now even in the mid to upper 5s. We've seen this now really starting to have an impact on several people. Usually in the beginning, I was saying, okay, this is going to impact maybe a small amount of people. With the rates going up, it's going to impact their payment. But it going up as much as it has now, we're starting to see it impact a larger group of people. You can literally see a difference of, $500, $600, $700 a month in someone's payment. Obviously depends on the loan size. The lower the loan size, not as impactful, but larger loan size, absolutely, that's going to be a significant increase in payment. So it's really important to know this because if you were kind of on the borderline of getting it pre-approved or your ratios were tight, it's important to know this because you definitely want to reach out to your bank or your loan officer, update your pre-approval letter, okay? But listen, this is not all doom and gloom. One thing I want to share with some of you that, maybe are panicking because you're like, oh my gosh, I need to buy. We're getting, our leases up. We're getting kicked out of our property, whatever the case may be. Kids are starting school. You need to be in a new area. I know rates are high and I know inventory is scarce, but there are some opportunities still out there with purchasing a home. But here's the thing about rates. I get that the payment is much higher than maybe it was last year, right? But don't think of this when you come into it that this is going to be your payment for the next 30 years or next 20 years. I've been doing this 24 years and I can honestly tell you there is very few, if any, people that I know that we got a mortgage 10 plus years ago that still have that same mortgage. The likelihood that you will probably sell or refinance especially is very high as opposed to you keeping that loan for 10 plus years. So I really want to stress that to you because, even prior to COVID, rates were pretty good. And people thought, wow, this is phenomenal. I have a rate in the low 4s or upper 3s. COVID hits and people are refinancing that literally had just purchased the year before. So I'm a believer that, when we've seen such a significant increase in such a short period of time, I think we're going to see the pendulum shift the other way here. Probably in the next year or two, could be shorter. Really don't know. I know it's hard to say. There's a lot of factors, but my point is that I don't think you're going to have these payments for a long period of time if you're buying now. Just know that you will have the opportunity to refinance. And because of that, I would even encourage you to look into maybe a 5-year ARM, a 10-year ARM. Those are fixed for 5 years. And if you do a 10-year ARM, it's fixed for 10 years. So you won't see a change in those periods. So might be a great option for you to take that now, maybe get a slightly lower payment. And then, like I said, when the opportunity presents itself, when rates go down, you can always refinance at that time. So anyway, if you're a buyer out there, keep your head up, stay optimistic. Realtors, same thing. I know it's challenging, but stay strong, stay positive. If we can do anything to help you guys, feel free to reach out. We're always here to help. I hope you guys all have a great weekend. And to all my moms out there, happy Mother's Day. We appreciate you. All right, take care. Thank you all. Bye-bye.